Frasers Group did not arrive at this bid from a standing start. The company already owned just over 26% of Hugo Boss before Wednesday's announcement. That is a blocking stake, large enough to frustrate any rival approach, large enough to complicate Hugo Boss's own capital allocation. What it is not large enough to do is generate a return without control. Minority stakes in publicly listed fashion houses do not compound quietly. They generate boardroom friction, they attract regulatory scrutiny, and they sit on the balance sheet as a visible liability whenever the underlying stock moves against you. Hugo Boss had a difficult stretch before this bid. The stock was under pressure, precisely what created the window. Mike Ashley's method, repeated across Frasers' history, is to accumulate at a discount during periods of sector distress, wait for a moment of maximum leverage, then formalize control. House of Fraser, Debenhams, and a string of smaller brands all followed a version of this pattern. The 26% stake in Hugo Boss was not a passive financial investment. It was the first chapter of an acquisition that was always going to arrive here. The offer of €38 per share, totaling approximately 1.98 billion euros, formalizes what the stake already implied. The only open question was timing. And now timing has its answer.
Here is the signal that changes the entire analytical frame. Hugo Boss shares jumped approximately 10% on Thursday and were trading at around €39 per share. The offer is €38 per share. Hugo Boss is trading above the bid price. In any clean, finalized takeover, the target stock trades at or just below the offer price, reflecting deal close risk. When the target trades above the offer price, the market is making a specific and explicit claim: the offer on the table is not the final offer. The market is pricing a higher bid. That single observation reframes every other question about this deal. It means institutional arb desks have looked at the €38 figure and concluded it is insufficient to close. It means Hugo Boss's board, when it says it will thoroughly examine the approach, is negotiating, not deliberating. There are two mutually incompatible readings of this situation, and both are defensible. The first reading, the market is correct. Frasers will be required to raise its offer to secure Hugo Boss board recommendation and shareholder support. A revised bid above €38 will be announced within weeks. The second reading, the market is wrong. The arb trade is mispriced. The €38 figure is Frasers' ceiling, not its floor. If Hugo Boss's board rejects the offer or demands a price Frasers will not meet, the deal stalls. Hugo Boss shares correct sharply back toward pre-bid levels, and Frasers is left holding a 26% stake in a company whose stock just fell on the back of a failed takeover. Neither outcome is remote, both are plausible. That is what rational paralysis looks like. The price above offer signal does not tell you which scenario plays out. It tells you the stakes of getting the read wrong are immediate and measurable.
Assume for a moment that the market's read is correct, and Frasers does raise its offer. The current bid is €1.98 billion for the shares Frasers does not already own. A sweetened offer does not simply add a rounding error to that figure. Even a modest uplift of 5% to 10% above the current offer adds hundreds of millions of euros to the acquisition cost. Frasers Group shares fell 2.5% at the open on the day of the announcement. They recovered to close up 1.1%. That intraday swing is telling. The initial market reaction was negative. Investors priced in balance sheet strain and deal execution risk. The recovery suggests some confidence in strategic logic, but the gap between the opening drop and the close tells you the market has not resolved its uncertainty about what this deal costs Frasers. There is also the Mike Ashley variable. Ashley has delivered transformational deals before. He has also pursued high-profile targets and walked away or had bids rejected. His deal-making style is personal, unconventional, and difficult to model using standard acquisition frameworks. That non-economic unpredictability is not a footnote. It is a structurally relevant risk factor for anyone trying to assign a probability to deal completion. For Frasers holders, the frame question is direct. If the deal closes at or near the current offer price, the strategic case, control of a global fashion brand with significant wholesale and retail leverage, may justify the capital outlay. If the deal requires a materially higher bid, or if it collapses, Frasers is left with an oversized minority stake in a structurally challenged asset and a balance sheet that bore the cost of the attempt. The risk structure of holding Frasers shares has changed. It was, before Wednesday, a retail conglomerate with a large minority stake in a European fashion house. It is now effectively a pending acquirer, with all the binary outcome risk that implies. The checkoff anchor is the Hugo Boss share price. Watch whether it holds above €38 in the coming sessions. If it does, the market is maintaining its higher bid expectation and deal pressure is intact. If it falls back toward or below 38 euros, the market is repricing deal failure risk, and Frasers' own shares will follow. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.